Hello, everybody. My name is Brian, and we are going to get started here with our monthly webinar series. We're going to be talking about a topic today that we've had probably the opportunity to talk many times, and it is specific to the bucket plan. And the bucket plan is something that we do here at Keystone that is the foundation of many of the retirement plans that we put together. And so we feel that this is something that is worthy of continuing to talk about. What we have found a lot of times is even when we talk about something initially and we go through it with you on a regular basis, it's always good to have a reminder. So we wanted to take some time today and just refresh you about what the bucket plan is and how it can help you weather the storm and prepare you for your retirement. So if I haven't met you, my name is Brian Manier. I'm one of the managing and founding partners here at Keystone Financial Group. I love the opportunity to take this time once a month and go through these different topics with you. So what we want to do today as we get into the bucket plan, the first thing that we want to do is just to talk a little bit about some of the financial history or some of the major financial history that has happened in our country. And the first thing that we want to talk about is the dot-com bubble. And some of you remember this happened back in September of 2000, ran its course for about 2 years. And what you see here was a pretty significant loss in the market. For those of you that remember 20 plus years ago, these series of events, what you saw here was we had a 25-month period of a down market, and it took 42 months to fully recover. So many of you will probably remember that. Some of you probably put that in the back of your mind and tried to forget it just because it was a very painful time period. But that was one of the time periods that had a really major impact on a lot of our finances. Another one that many of you probably remember was the financial crisis that happened back in 2008. When we look back at this happened between 2007, 2012, 17 months were down, and it took 36 months to full recovery. Now, why do I bring those two events up? I bring those up because we want to make sure that when we are preparing for retirement or in retirement is we want to make sure that we are prepared if something like that happens again. Now, I'm not always a big advocate of just because something happened before, it's going to happen again. But what I am an advocate of is making sure that if something like that were to occur, are you prepared, or how do you get prepared for some sort of occurrence like those two time periods? Now, when you have that type of volatility, the response that you have does matter. And we're going to talk about that as we get into the bucket plan. Now, when you look at the response, not only do you want to make sure that you're prepared for those losses, but you also want to make sure that you respond appropriately for what will happen after that type of volatility. So when you look at this particular chart, what you see here are different investors that had a different response or reacted differently in 2008, specifically to the 2008 financial crisis. So what you see here when you start with the apprehensive investor, this is somebody who moved cash at the start of 2009 and remained there. You can see not really a whole lot of growth. Their money really didn't do anything for them. Then you look at the uncertain investor, and this is somebody that I would say we see on a regular basis, somebody that has a little bit of hesitancy. What do they want to do? How do they respond to this? And so this would be somebody that moved to cash at the start of 2009 and kept it there for about a year. Okay. And you can see when they invested the amount that they did, you can see the growth that they had. And this would be somebody that is unsure. We would see this in 2020. We saw this even in 2022 when the market dropped almost 20%, that there were people that just were unsure and they wanted to put money on the sidelines because they didn't want to experience any further loss of their money. Well, compare that to the steady investor. This is somebody who stayed the course and they didn't make any changes in 2009. And you can see that this person actually outperformed the uncertain investor. And the reason for this is because trying to time the market is very, very difficult. It's something that we don't advocate for, and we don't know when the market is going to recover. It's very difficult to determine when that will happen. So you can see in this chart between the steady and the uncertain investor that the steady investor actually had more growth, optimized what this person did in their portfolio. And this is important because investors can use this to help understand how different reactions to market volatility can impact long-term outcomes. And so this bucket plan that we're going to talk about is going to prepare you for both the volatility, but also prepare you for what to do after the volatility and when those growth periods occur. So as we look into this, we want to talk about three major risks that we want to identify and make sure that we prepare for. And the bucket plan is a plan that will help you identify and prepare for those major risks. So here are the three risks. Let's first talk about what market risk is. And this is something that many of us are familiar with. So we know the stock market, it's like a roller coaster. It's going to have its ups, it's going to have its downs. Unfortunately, we just don't always know when those ups and downs are going to occur. Now, when you look at the history of the market from 1926, and in this particular slide, it runs through 2020, you can see the blues and the reds. So the blues are the positive, those are the bull markets, and you can see the red, which is those negative time periods, and those represent the bear markets. A lot of times when we're experiencing those bear markets, it feels as if it is a long time and it feels really significant. But when you look at this chart, what you have seen throughout the course of the market history is those periods of growth are actually a lot more and a lot more significant than what you see with the bear market. So that's something to keep in mind as you are preparing with how to go about creating a plan and putting together your bucket plan. And so it's important to know, since 1926, the stock market has rewarded investors with an average return of about 10%. Now, some people would say, man, is that really right? But when you look at the overall average from 1926, it is, in fact, a double-digit return. Now, it's important, though, what you got to remember that returns in any given year can be really high and they can be really poor or anywhere in between. We just don't know. And it's sometimes difficult to predict what those are going to be. In fact, when you look at those yearly returns, they've ranged as high as 54% and as low as 43%. So those are really significant swings in how the market can adjust. And so we want to make sure that we're prepared for both bad markets, but also good markets as well. So let's look at the second type of risk, and this is interest rate risk and decreasing purchasing power. So when you think of interest rates, let's talk about how bonds react to interest rates, because this is a conversation that we have on a regular basis. What can I do to protect some of my money to mitigate maybe some of the market risk? Well, what we hear a lot of times is people will say, well, I can put these in different types of bond portfolios. Now, here, this is a really important concept to understand on how interest rates work, especially if you have a bond portfolio. Most people that we work with, when they are utilizing the money they save for retirement and they're taking distributions so that they can live in retirement, most people have to utilize both principal and growth. So think about that, principal and growth. So if you have a bond portfolio and we're in an interest rate environment, like an interest environment that we have just gone through, where interest rates have gone up, when you go to sell a bond or when you sell multiple bonds or part of a bond portfolio, what you are selling those bonds for is actually less than the initial value when you bought it, because as interest rates rise, the cost of that bond decreases. So that means if you are somebody that has to live off of both principal and growth, that understanding how interest rates work in the interest rate environment is going to have a really big impact on the overall value of your retirement assets. And so this is important to understand if you're somebody that just feels that a bond portfolio is the right way to establish mitigating market risk. You also have to understand the interest rate risk and what that does to the overall portfolio. In addition, we have to look at, well, what is the dollar worth and what is the purchasing power of the US dollar? And this is such a hot topic right now as we talk about inflation and what inflation has done over the last few years, what it's even done from a cost of living adjustment with Social Security. You see this a lot in homes right now, and the prices of houses and how they have skyrocketed. And so understanding what the dollar is worth and what that means for you as you're preparing for putting your retirement plan together, extremely important in understanding that. Also want to talk about what we call sequence of returns risk. And this is one of the things that we feel is vital. It is so important to understand this as you are preparing for retirement, or even if you are in retirement. Now, sequence of returns risk is a fancy way of saying when you take money from an account that has lost value because of a bad market, even when the good market comes back, you have positive returns in your portfolios or your retirement assets, you can never make up what you lost. So let's look at this scenario. Let's look at two people here that have deposited $100,000 into their retirement accounts, and they've had 10 years to grow these assets. And let's say over the 10-year period, there's an average rate of return of 6%. Now, when you look at the person on the left, you see that there are very large gains in years 1 and 2 and very large losses in years 9 and 10. And then when you compare that to the person on the right, there's very large losses in years 1 and 2 and large gains in years 9 and 10. So basically, these scenarios have just flip-flopped. Now, what's a really important observation when you look at the ending values is they're the same. No money was taken from either account. The market did its thing. It did it differently in these scenarios, but as long as the time period and the average rate of return were the same, you see here that the ending balance was the same for both of these individuals. Now, where this changes is now we're going to add another column. And now what we're going to do is have each of these individuals take a $6,000 withdrawal from each account. Now, when you look at this, you can see what happens is the person on the right has a lot less money than the person on the left. This is what we call sequence of returns. And the reason this happened, even though the rates of return for the 10-year period were the same, is that that person on the right experienced those big losses in years 1 and 2. And when that happens, you cannot recover what you lost, even when the market was cooperative, even in years 9 and 10, when you had a 20 and a 30% rate of return. In the positive way, it still has a detrimental effect on the overall account balance. So one of the things that we talk about when we are putting together retirement plans is we want to make sure that you avoid sequence of returns risk, because we feel that it is one of the most detrimental things that can happen in your overall retirement plan. So those are the 3 risks that we just talked about. What can we do about those? What can you do to help prepare for those 3 risks? This is where we implement the bucket plan. And as I alluded to earlier, what the bucket plan does is it prepares you for bad markets, but it also helps you in good markets as well. So let's look at what the bucket plan is. Many of you are very familiar with this. You have 3 buckets. So as we put together a retirement plan, what we do is we want to segment assets in a now, soon, and later bucket. And even if you're somebody, let's say you're watching this, and let's say you're in your 30s or your 40s, a bucket plan can still be applicable to you. There's still relevance regardless of the age. It's just going to look different depending on where you're at in your stage of life. So let's go through each of these buckets and talk about what they are and how they can help. So the first is your now bucket. So your now bucket, this is money that you're going to put into a safe and easy accessible type of account so that you can get to it when you need it. Typically what we would see in this is emergency purposes. You want to have enough money set aside for 3 to 6, some people like 12 months worth of income in that now bucket. That's going to be a little bit different for different types of people depending on your situation. This is also going to be a bucket that we're going to use for planned expenses. So if you know you're going to buy a car this year, or you know that you have some work around the house, or you have that vacation that you've been saving for. You're not trying to grow that over the course of the year. You're setting aside that money. It's earmarked. That's in your now bucket. You know you're not going to lose if the market takes a dip. And so that is there. It's accessible for you. So this is money that you're setting aside for the unexpected and for planned expenses. Let's talk about the soon bucket. The soon bucket, for most people that we start to work with, we find that many people don't have a soon bucket. The soon bucket is set for you to take planned expenses. So this is a bucket where you want assets or different types of accounts that are going to outpace what a bank account would do, or even outpace inflation. But at the same time, you want to take very minimal risk, if any risk with this. And the biggest thing is this is the bucket that's going to help you offset or mitigate those three types of risk that we talked about. Market risk, we talked about inflation risk and interest rate risk, and sequence of returns risk. So this is the bucket that I would say is the linchpin of the retirement plan, because it's going to mitigate those three types of risk. And what we do is find strategies that can do that for you, where it can still outpace inflation. It's going to grow more than what your bank account is going to grow at, but at the same time, it's going to mitigate those risks. Very important. And then your later bucket. So what we want to do is, after we solve how much we're going to put into your now bucket and your soon bucket, now we want to build the later bucket. And the later bucket is where you're going to get your long-term growth. This is the bucket that we like to see keep pace with what the overall markets are doing. In addition, this is your legacy planning. It's also going to be how you plan for long-term care and disability. And that's going to be different for the different types of investors that are out there. Legacy planning, a lot of times when people think about that, they think just about their kids. But when you think about legacy planning, one of the most important aspects of legacy planning, if you're married, is your spouse. Because what we find a lot of times is, especially if both of you are taking Social Security, now one of those benefits has been taken away. And so legacy planning is really important, not just for the kids, but for the spouse as well. And this is how we do that, by putting this in that later bucket. So when we look at this, what we see a lot of times, most of the time when people come in and they want to work with us to try to put together one of these bucket plans, or just they're curious about the best way to put a distribution plan together, what we see in many cases is people will have a now bucket and they have a very good later bucket, but they're lacking that soon bucket. And as I mentioned before, that's really the linchpin of the entire plan, because now we're putting that soon bucket so that you can plan for distributions that are going to occur sooner rather than later. So that is the value of the bucket plan, is that it does prepare you for both bad markets and good markets. Now, bucket sizes are going to be different for each person. So when some people will initially look at this, we'll say, okay, so you're just going to take the assets that we have and divide them into a third, a third, a third. Or will they, sometimes we'll get, well, you just take the later bucket and divide that in half and put half of those later buckets in my soon bucket. Well, the reality of it is it's different for every type of person. So as we mentioned before, if you're in your 30s or 40s, having a bucket plan is still relevant, because what it does is that soon bucket now creates what we call an opportunity bucket. How many times in your life have you come across a property and you think to yourself, man, I wish I would have had some money that I could have bought that property? Or somebody approaches you with a potential business ownership, being a partial business owner, or buying a business, or just starting your own business. What we realize is most people aren't just going to fund their now bucket over the course of their life and try to build up as much as possible, because they know when they do that, they're not earning any money or growth on that. But creating a soon bucket, even when you're younger, earlier on in your career, this creates what we call an opportunity bucket. Now, what we realize, if you're younger, that soon bucket is going to be smaller than somebody that is getting ready to retire or that's in retirement, because that soon bucket now has to create regular income streams over the next 1 to 5, upwards of even 10 years. And so that soon bucket for someone that's older is going to be larger. But the bucket plan is relevant to anybody at any age because of the opportunities that it does provide. We also see this, somebody that just has so much money in cash because maybe this person is market adverse or they just want to have that available to them. Just know there's a trade-off. You may not be losing any money, but you're also not keeping up with inflation by putting all of that money into bank accounts or just cash type strategies that are out there. So be aware of that you can do that, but it is going to cost you, even if you don't lose money, it's going to cost you growth and you're not going to keep up with what inflation is doing. As we mentioned before, that soon bucket, so critical. It mitigates these three risks that we talked about before: market risk, interest rate risk, and sequence of returns risk. And this is something that we feel is so critical when you're putting together a retirement plan and you're getting ready to retire and trying to figure out how to take those distributions. The soon bucket is going to allow you to mitigate those three types of risk. So we feel that this is a great way, it's a great foundation to put together your retirement plan so that you can feel like you have a plan, but also it creates a strategy that's going to prepare you for those situations that we talked about when we first started this presentation. So things to consider, things to get ahead if we're not in a market crisis right now. As of today, the market's actually doing quite well, but in the event that it does, and at some point we will have another correction in the market, how we get ready for that is first, assess your now bucket. Do you have enough money set aside for potential income loss? Do you have emergency or even a comfort fund? If you are someone that likes to go on vacation on a regular basis, do you have money set aside for that? And any planned expenses that you're going to account for? Do you have that? Is it set aside, and is that something that you do on a regular basis? Second thing that we want to do is evaluate your volatility tolerance or your risk assessment, and doing that both in your soon and later buckets. What we found with a lot of people that we work with is they may have been working with someone that has taken them through a risk tolerance, but that risk tolerance is done with all of the assets that they have. What we want to do is segment those into that soon and later bucket, because we feel that it better prepares you for distribution planning. One of the ways that we can do that is if you haven't had this, we can go through that risk assessment. And then what we can do is we can actually do an audit of your portfolio. We can audit any retirement statements that you have and see if you are in alignment with your overall risk assessment based on the results of that audit. And then what you can do is, as you assess your now bucket and you reevaluate your risk assessment, some other things to consider as we do this is ask about Roth conversions and contributions. One of the things that we want to do when we implement these bucket plans is we want to make sure that we're having a conversation about taxes and what taxes are going to do in the future. And so our Roth conversions are appropriate, and depending on how your buckets are set up, Roth conversions may be something that you want to implement into your overall plan. For those of you that have taxable accounts or joint accounts with your spouses, is it appropriate for you to harvest tax losses by looking at those statements and finding which one of those either funds or investments that you have haven't done so well, and is it appropriate to take those losses to help you mitigate taxes? Also, evaluate contributions and distributions of your plan. If you're still working and you're contributing to, let's say, a 401k or your employer-sponsored plan, what percent are you doing? And is your employer matching? And what percent is your employer matching? What are you doing outside of that? And so we want to just make sure that we're evaluating those contributions, any distributions that you're taking as well. If you're somebody that now you're in retirement and you're taking distributions, are you doing that appropriately? And are you doing that tax efficiently? Are you doing that by avoiding sequence of returns risk? So we want to make sure that you're doing all of those things and you're doing all of those things appropriately. And then finally, just rebalancing your portfolio, making sure that even if your later bucket investments that you're not pulling right now, just making sure that it's in line with your risk assessment and it's doing what you want it to do compared to what the overall markets are doing. So if you feel like you want to have some further conversation about this, if you're someone that's working with us already, we should be talking to you about these things. And if you're new to us and you came across this and you're hearing this for the first time, I'd love to have a conversation with you. You can contact Rose. Her information is on the screen there. Feel free to call her or email her in our office, and she will set a time with one of the advisors here. So hope this was helpful. Love to talk about this further with you the next time that we come in contact with one another. Want to wish you a great rest of the week. Thank you for your time. Look forward to talking to you in the near future.